what do you expect in recessions? So to me, this is part of that silly stage where in some measures it's collapsing, and it certainly should, it will, it's just a matter of time. And we get, and it's actually deflation now in terms of producer price indexes, and it's deflation in terms of all commodities. The only thing that make commodity go up is currency debasement, and I can show you that in other currencies other than the dollar. But the key question is, what do we do to stop this transition from disinflation to deflation? To me, that's the silly stage we're in right now. And it's just a matter of time the market realizes, everybody realizes, oh, this is what happens in recessions. We go from excessive inflation to deflation to disinflation to deflation.
Rating agency Fitch on Tuesday downgraded the United States long-term foreign currency ratings to AA+ from AAA, reflecting expected fiscal deterioration over the next 3 years as well as a high and growing general government debt burden. The downgrade follows a debt ceiling agreement in June that came after months of political brinkmanship and ultimately lifted the government's $31.4 trillion debt ceiling. In Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025, the rating agency said in a statement. As a result of the downgrade, the dollar moved lower against a basket of major currencies after the announcement. Let us join Mike McGlone and Lyn Alden as they review the U.S. economy, throwing light on equities, monetary and fiscal policies, and also address the expectations of a pivot. As we dive in, make sure to hit the like button, subscribe, and drop your comments below.
Key thing I want to focus on right now is, to the macro, is I have never seen, I've only 58, a point in my life where there's more risk for everything, the global economy akin to 1930, that the stock market has to go up. Like you pointed, it has to go up. If it doesn't, everything trickles down. Everything. Housing's already started. Inflation's already started. Everything is started. If the stock market just starts to give up, I'm not talking about a crash, a normal period of underperformance. Now, Dave and I have experienced two key ones since the stock market crash, the peak in 2000, the peak in 2008. Question I want to ask everybody who's been managing money and who's been only doing it for 20 years versus 40 years is, do you expect in your lifetime you're going to get an elongated period of underperformance in equities? And if you don't, I'd say good luck, because it always happens. And it always happens. It hurts the most people, and it shit takes people on. I've just never seen a better environment where the Fed are still tightening. Everything's starting to roll over in the stock market. It's different this time. I look at it as, don't fight the Fed. We've heard that before, but it's still happening, which is what scares me. And then, like, I look at all my indicators, the commodity market tell you, yeah, this is a global problem, and you probably should just be careful.
I'm not expecting a pivot anytime soon, but like Mike, I expect generally like equities to not have very good performance, and that doesn't necessarily mean a crash. You can have a choppy range for a while, and this particular rally has gotten, say, higher than I would have guessed, but even if it touches nominal new highs, I just don't think that basically measuring from the late 2021 peak to 5+ years after that, I don't think that's going to be looked back upon as a very good period of equity returns. And I don't know the path we're going to go along to get there, but when you go into it with high valuations and then you run into some of these headwinds, the Fed fighting against you, some inflationary pressures, it's kind of a recipe for not great performance. And I think when we look at the economy itself, one thing that the market has been consistently off sides on for the past few years is the power of fiscal. So there's been so much focus on monetary policy, but I think it often underestimates the power of fiscal. And so the amount of inflation and stimulus that the 2020 and 2021 fiscal injections did were underestimated till they started materializing. And then even now, even with that period behind us, the sheer size of the deficit we're still running, I think is a key variable for why a lot of this keeps getting pushed out beyond what the market thought, because it's a different type of fiscal, but it's still a type of fiscal. And then, it's offset partially by, everyone's kind of surprised by China's lack of oomph in their reopening. And again, it's largely a fiscal question. Basically, they've been in the opposite, where they're running very tight fiscal, and that's been a key variable for why they've been slow out of the gate. And so I think the main thing to follow on a lot of this is what's happened with fiscal, because I think the market's just been generally offsides in terms of either when it's either working in your favor or against you is just the sheer power that fiscal has compared to other variables we can look at, like monetary and elsewhere.
Japan's government bond market has turned into a cat and mouse arena for investors and the Bank of Japan, as the latter tries to slow a rise in yields towards its new policy ceiling, and hungry investors go a step ahead and snap up the bonds. The game began after the Bank of Japan tweaked its complex 7-year-old yield curve control policy on Friday, saying yields on the 10-year Japanese government bond it targets can move flexibly and as far as 1% rather than be capped at 0.5%. When asked if the Bank of Japan decision would be enough to trigger a burst in the global market, Lyn Alden and McGlone had few things to say in that regard, as we would see in the video shortly.
So I classify it as a moderate event. I think it's more impactful for certain financial prices than for the economy. And so when you look at their yield curve control, they kind of struck the middle ground. So instead of actually increasing their yield curve control targets, they said, okay, we still have the same targets, but we're going to be more flexible in enforcing those targets. And so now, whenever JGBs trade between 0.5 and 1%. Yield, they're never quite sure if there's going to be an intervention or not. It's kind of like what the game they play with their currency over the past year, where they could come in with an intervention, and so probably the right price for it to settle somewhere between those figures. When we think about the purpose of raising rates in the face of inflation, there's kind of two main ways to think about it. One is that if they're trying to slow down bank lending, which I don't think Japan's trying to do, because they're not exactly known for their rapid bank lending environment. And then two, it's you're trying to firm up your currency. You're trying to improve the yield differential. You're trying to bring capital home versus have it go out. I think that's obviously the bigger story that they're trying to go with. And so to the extent that they're successful in that, that does all around the margins bring a little bit of capital back to Japan, or at least stop some of the outflows, which has implications for global bond pricing and then has implications for global equity pricing. So it's another risk factor among the other risk factors we've been talking about for things that could derail the equity rally. But I don't think it'll be hugely impactful for Japan's economy, around the margins, because we're talking about a fraction of 1% here.
We all knew it was going to happen. At some point, you hit the point where you can't just keep pumping the system with liquidity, and it ends. What did it end with? Inflation, most inflation we've had in 40 years. And what's happening to that inflation? It's collapsing in some measures, yet the Fed's still tightening. So the key thing is that liquidity. What's going to take for it to come back? So I look on the Bloomberg terminal, the Fed funds shows that by we get to the November 1st meeting, it shows we're going to have a 40% chance that they're going to hike another 25. So hopefully we'll get to a period that at some point they're not going to hike. And the key question you have to ask yourself is what's going to take them to stop hiking? And number one thing I think, as Dave has pointed out, is just a little bit more, okay, credit's contracting. We know that, and why it's still going to contract with the Fed tightening, but probably a stock market correction or plunging inflation.
The fiscal side is still, pro-inflation, pro-expansionary, and it's being offset by central bank trying to be restrictive. And I do think that the balance sheet reduction is probably having in some ways a bigger impact than the rates, at least around the margins, the fact that balance sheet reduction is still going on. And so the question is, if you have significant fiscal expansion combined with that monetary tightness, that's when you risk the crowding out effect. And that's, we saw it manifest in the banks. We can see it manifest again in other areas. We could, that could be a catalyst for the next stock market correction. Is that if you're still issuing more and more treasuries, those have to be funded, and that has to come out of somewhere. And if it's not coming out of the Fed, where's it going to come from, right? So that's one variable to kind of, I think, watch. And I think you can have an environment where it's somewhat stimulative for the economy, those fiscal deficits, but not stimulative for asset prices, because it's not combined with the central bank money printing. Now, should they run into a hard liquidity problem, like they did in September 2019 with the repo spike, or the March 2020, or the gilt crisis of 2022, if they have an event like that, or the banking issue early this year, if they run into one of those types of events and they have to reverse their balance sheet reduction and then flip towards monetary expansion, at the same time you still have the structural background fiscal expansion, that's when I think it'd probably be, off to the races, second wave of inflation. But until then, I think we're still in somewhat of a disinflationary period. Most inflationary decades came in waves. And the one time where you didn't was like, say, World War I, you had this huge spike in inflation. Then the war's over and you had that kind of post-war recession period of deflation. You kind of settle at a higher plateau of prices. Both the 1940s and the 70s, inflation came in waves. And the way I've been characterizing it this time is, we've been in this period of falling PMIs, economic deceleration, not as quickly as people thought because of that fiscal backdrop. I think that as long as we're in this kind of economic malaise, the risk still trends towards disinflation. But once either we get a liquidity problem or some other event, and we start to have a period of reacceleration, I think it's likely to come back with some inflation on the side because some of the structural drivers are still there. There's still the background fiscal deficit. I think there's been generally underinvestment in some of the energy and commodity markets. And I think that there's still more waves of that probably to come ahead, but that you have to actually watch the data to see if that monetary stimulus comes back. I think the fiscal alone is more that crowding out effect. That's kind of why we're in this like twilight zone right now.
According to Alden, the problem with the monetary and fiscal policies started way back, and all blame shouldn't be put on the present people in the reins, even though there are things they can do differently. Lyn Alden and McGlone share what they believe might be the best way forward in the present market conditions, with Alden saying she would resign if she was in the position and proposing digital gold as an important factor. Let's now get back in McGlone video.
People have often asked me what I would do, and I'd say resign. It's just not. It's not an attractive. Because it's not an attractive position to be in, especially the central bank head. Because the risk of fiscal dominance when you have this much treasury issuance, monetary policy becomes less impactful, and sometimes you get forced into decisions that are outside of your mandate because you now have this other variable to deal with, right? So you're trying to solve for both unemployment and inflation, and then it's like, well, here's walls and walls and walls of treasury issuance. What are you going to do about it? And that's just something that they have to deal with now. When you have public debt levels this high, historically speaking, those bonds are not going to likely maintain long-term purchasing power, right? Basically, there's tends to be default. Now there have been some exceptions. One exception was the United Kingdom in the 1800s. They got up to something like 200% debt to GDP, and they managed to sharply reduce it in real terms. But they had the tailwinds of an energy revolution, right? So the whole industrial revolution, giving them massive real growth, and then they also had all sorts of colonialist extraction from elsewhere, and so those two variables gave them like an exception. The length with which Japan is held out has been some of a historical exception. The fact that they've been able to maintain debt levels this high and this long, I think that's starting to bite them now. But still, they managed to push that longer than most. But normally, when you get up to well over 100% debt to GDP, some of that's just not going to be paid back in real purchasing power terms. And so it kind of comes down to managing that as gracefully as possible. And I think a big political error that they're going to have to deal with is, Social Security funding, things like that, right? Because when you look at the Social Security's forecast, they expect that the fund will be out by the mid 2030s. And at that point, either the spending gets cut or tax had to be raised or something. Means testing, I don't know the answer. But I think both from a monetary and, from the Treasury Secretary's side, these structural deficits, there's no clean way out. It's just you're choosing all between bad answers, which is why I tend to be, more critical of some of the early central bankers that I think that there were more choices back then that got us into this position. And now it's a Kobayashi Maru. Now it's just varying types of bad decisions, and I wouldn't know what to do.
All this money that's being allocated to there, and it's being told, everybody said, you got to be in it for the long haul. Just my lessons in life, you always learn those things have to be for good bull markets to start. You need to get a period of disdain. A long period, and we're nowhere near that. We had it for maybe a couple months and about a year, but I mean multiple years. So that to me is a big picture problem. Roping in the cryptos, I mean, yes, I completely agree. Bitcoin, digital gold is going to be more like gold, but show me the beef. I mean, like, it's just, I like to see a little bit of that positive performance in addition to the fact that it's already been the best performing asset in history of mankind. And now that everybody's so bullish, you got to be careful. And so that's why I still think enduring wise, I see gold's up almost 10% this year. That's pretty good. Industrial metals down 10%. That's bad. What stops that? And I just still see every central bank is, look, they're still tightening, and we're hoping that China will do something to help us.
U.S. and European officials are growing increasingly concerned about China's accelerated push into the production of older generation semiconductors and are debating new strategies to contain the country's expansion. President Joe Biden implemented broad controls over China's ability to secure the kind of advanced chips that power artificial intelligence models and military applications. But Beijing responded by pouring billions into factories for the so-called legacy chips that haven't been banned. Such chips are still essential throughout the global economy, critical components for everything from smartphones and electric vehicles to military hardware. That sparked fresh fears about China's potential influence and triggered talks of further reigning in the Asian nation, according to people familiar with the matter, who asked not to be identified because the deliberations are private. The U.S. is determined to prevent chips from becoming a point of leverage for China, the people said. Senior EU and U.S. officials are concerned about Beijing's drive to dominate this market for both economic and security reasons, the people said. They worry Chinese companies could dump their legacy chips on global markets in the future, driving foreign rivals out of business like in the solar industry, they said. Western companies may then become dependent on China for these semiconductors, the people said. Buying such critical tech components from China may create national security risks, especially if the silicon is needed in defense equipment. The U.S. and Europe are trying to build up their domestic chip production to decrease reliance on Asia. Governments have set aside public money to support local factories, including the Biden administration's $52 billion for the CHIPS and Science Act. But domestic producers may be reluctant to invest in facilities that will have to compete with heavily subsidized Chinese plants. The Biden administration and its allies are gauging the willingness of Western companies to invest in such projects before they decide what action to take.